U.S. President Trump has criticized U.S. oil companies for their massive profits, saying a shortage of oil has helped them this year. But he expects prices to drop after the war with Iran ends.
They're making too much money, okay? Based on a shortage, they're making too much money. I don't like it. And I should be the last one to say, because I'm a big free enterprise guy, nobody bigger. And, you know, you're going to see oil, when we're finished with Iran, you're going to see the prices drop through the floor. But they made too much money, too much money. Chevron, too much money. ExxonMobil, too much money.
All right, I want to pull in now Harold Skip York. He's Chief Energy Strategist at Turner Mason and Company. He's a longtime energy market analyst with global oil market expertise. He's also now a non-resident fellow at Rice University's Baker Institute. Skip, it's good to have you on the program. Too much money. Don't we wish we had that problem? U.S. President Trump saying that Chevron and Exxon are making too much money. Is that evidence of corporate excess, or is it simply what happens when supplies are tight and markets are doing exactly what markets are supposed to do?
I think this is more of a case of the market is doing what the market is supposed to do. I mean, we saw strong earnings among the oil companies, but they were across the board, across all segments. More money made, high earnings in the crude production, what we call the upstream. Refining made more money. Marketing made more money. Even petrochemicals saw stronger earnings now than we've seen in 7 years. And a lot of that just has to do with not only the limitations of crude and products moving through the Strait of Hormuz, but we have a lot of capacity that's offline through either damaged facilities inside the Persian Gulf or damaged facilities in Russia from the Ukrainian drone strikes. So when you combine those two conflicts together, we're down about 10% of the world's refining capacity is offline right now, at a point where we're at the high point of the demand season.
The president says that once the situation with Iran is resolved, prices will drop through the floor. Those are his words. How much of today's oil price is really tied to Iran and the broader Middle East risk?
So if you sort of say that today we're sort of sitting at about prices are sitting about $80 today. They were a little bit higher than that last week. There's probably about $8 that you probably need to, that you could see $8 to $10 come out of the oil price once all the risk gets resolved. We won't go back to a world of $65 a barrel where we were pre-conflict, because we've drawn down a lot of stocks. Those stocks have to be rebuilt. And as they're rebuilt, that just creates a sort of demand while we're rebuilding those inventories. So what I would sort of expect to see is that when all the crisis eliminates itself and we start getting back to normalization in the Strait of Hormuz, I would expect to see oil prices more in the low to mid 70s, but certainly about $10 higher than what we saw before the conflict started.
Yeah, the president, he singled out Exxon and Chevron in his comments, but are these companies, are they setting prices, or are they responding to prices being set by a global market that is far larger than any one company?
Yeah, they're all price takers, whether it's Chevron or ExxonMobil, the other integrated oil companies like Total Energies, BP, Shell, but even the independent refiners we see in the United States like Valero, Marathon, they all had a very strong earnings season in the second quarter, but they're all price takers because none of them are large enough to actually have enough supply to influence where the price moves. And so they're just responding to the supply-demand imbalance because we've just lost so much supply relative to demand. And I'll just come back to we're in the seasonally high peak part of the demand season in the second and third quarter. And when we get to the fourth quarter, then I think you'll start to see a bit of that price pressure. Whether it drops like a rock, like the president would like to see, that I'm not so sure of. But I do think he's right that as we alleviate tensions in the Middle East and we get to that seasonal low part of the demand season, the combination of those two will put downward pressure on prices.
Some investors would argue that strong profits are exactly what encourage more production and ultimately lower prices. Is that a fair argument when we're talking about oil and the energy market?
That's normal. Historically, that's been true, and especially in the United States with our shale producers. They used to be very price sensitive to the upside. We saw slight upticks in prices and a big increase in activity. That's not happened in this cycle. This time, the oil producers in the U.S. and especially those independent shale producers have talked a lot about being more capital disciplined for the last 6 years since coming out of COVID. And this year, we're actually seeing it. There's only been literally a handful of companies that have increased their spending on capital projects since the beginning of the conflict. Most of this is going, it's going into those earnings. Those earnings aren't converting into more investment in 2026. When we get to December, it'll be interesting to see as they set their capital budgets for 2027, will we see an increase in capital spending to reflect that increase in earnings that they're capturing this year?
Yeah, it'd be interesting. We'll definitely be watching that. Skip, unfortunately, we're out of time, but we appreciate you helping us understand these fluctuations on energy markets. Thank you.
All right. Thanks for the opportunity.